Hey everybody, welcome back to Dividend Stockpile, where we talk all things dividend and income related. In today's video, I'm going to talk about the dividend stocks and funds that I plan on buying in Q4 2024. It's surprising that we've already gotten three-fourths of the way done with the year, only a quarter left to go, and we don't know what the future is, but so far in 2024, it's been an excellent year for equities. S&P 500, NASDAQ, the Dow even, they're all at all-time or near all-time highs. We'll see how the rest of the quarter goes. But at the end of the day, we're long-term investors as dividend growth investors. So, the ups and downs of the quarters don't really matter too much to us. But we want to go ahead and continue to buy good companies at a reasonable valuation and collect those dividends over time. So today I'm going to talk about a total of 5 different stocks and funds that I plan on buying in the next quarter. So let's get started. Okay, first up, I'm going to be purchasing more of this ETF. Ticker is REGL, the ProShares S&P Midcap 400 Dividend Aristocrats ETF. It's quite a mouthful, but as the name suggests, it invests in dividend companies in the S&P 400. So these are the companies right underneath the S&P 500 companies. So you're talking about mid-cap, mid-sized companies that aren't necessarily in the S&P 500. They're not the largest companies out there, but they're still relatively large and they continue to be growing. So going to take a look through Seeking Alpha here, as you see. I'm going to go ahead and talk about the returns, the holdings that they have, the different sectors, and a little bit about the dividend and dividend raises. So as you see here on the screen, over the last 5 years, price appreciation alone for REGL is 41%. So very solid, very stable. It basically matches the long-term average of the market, an 8% increase. But remember, you also have to add dividends received on top of this. And as we'll see in a little bit, that adds a couple of percentage points. So let's look more into what this ETF is all about. Scrolling down, you can see that it is an exchange-traded fund managed by ProShare Advisors, LLC. And it looks to seek the performance of the S&P 400 Dividend Aristocrats Index. It's been around since 2015. And scrolling down a little bit more, you see it has an expense ratio of 0.40%. While it's relatively high compared to some of your other ETFs out there like SCHD and GGRO, because this is a more specialized niche of the market and with mid-caps, the price of management is a little higher. Still very reasonable, especially when you look at the returns you can get. Looking at the holdings breakdown, you can see it's well diversified between financials, utilities, industrials, consumer cyclical, basic materials, healthcare, real estate, consumer defensive, and energy. So of the 11 different sectors, it covers at least 9 of them, so you can get proper diversification. Looking at the top 10 holdings right now, we're talking about Renaissance Re Holdings, which is a reinsurance company. We have REGL Rexnord, Polaris, which is the recreational vehicles, Hanover Insurance Group, RPM International, Ryder, Old Republic International, which I know is a favorite among many dividend investors, and a couple other ones that you may or may not have heard of. What I love about this particular fund is its relatively small holdings. There's only 50 holdings right now, and they are equally diversified amongst each holding. So as you see here on the screen, each holding is around 2 to 2.25%. So this provides the broad diversification you want without getting the excess exposure to a single name like you would in the S&P 500. If you look at those, the top holdings are 8 and 9%. And with this one, it's going to be in the 2 to 2.25% for each particular holding, which allows you to get proper diversification. Looking here at Seeking Alpha, the current yield is 2.30. So it's much higher than the S&P 500, but not quite as high as something like your SCHD. But what is really impressive about this particular fund is the 5-year dividend growth rate. It's showing an 11.3% 5-year CAGR. If you remember from a previous video, I like the Chowder rule, which says that if you add up the current yield plus the 5-year dividend growth, you should be looking for a number at 10 or higher, ideally 12 or higher. And looking at this particular ETF in both metrics, you can see that it beats both the 10 and the 12. So it's a very good combination of current dividends as well as dividend growth over time. Okay, scrolling back through Seeking Alpha, wanted to show the total the dividends on a long-term basis. So as you see right here, the 1-year dividend growth rate is a little over 12%, 3 years a little low at 2%, but over the 5-year CAGR is 11.3%, like we talked about. All right, let's talk a little bit more about what REGL does and what they invest in. So as you see here, according to ProShares on their website, it's the only ETF exclusively covering the S&P Midcap 400 Dividend Aristocrats, which, as it says here, are high quality companies. They have paid dividends and grown them for at least 15 years. The investment objective is to follow the index, which we'll talk about in just a second. Going over to that index, you can see the criteria that they utilize. It's the dividend growth is their main criteria. It must have increased the total dividends per share every year for at least 15 consecutive years. So that's a great combination of growth ahead as well as the proof that they can raise their dividend over time. So once they get the list of all the companies who have raised their dividends in the mid-cap space for 15 years, then they look for a minimum of 40 holdings. And they're going to rank each of the holdings by the length of the dividend history. So the ones that have the longest dividend growth are going to be included. And then once the 40 has been met, then they'll stop there. And then every year they reconstitute, and they're going to reevaluate the holdings and make sure that they're proper weightings. And they also don't allow any one sector over 30% of the index. As we looked at back in Seeking Alpha, if the financials are at around 22% or so, so if it was to ever get to 30% because those particular sectors went higher, then when they do the reconstitution, they're going to max out at 30%. Okay, so before we move on to the next one, I wanted to let you know that if you're interested in viewing the information that I'm showing in Seeking Alpha, I am an affiliate, and so there is a special going on right now where if you sign up for their premium service, you're going to get $25 off your membership. And as it says here, over the next couple of days, the price for the annual membership is going to go up. So you can go ahead and lock in your lower rate today, as long as you get there by October 1st. So the full link for for Seeking Alpha will be in the description below. No obligation, of course, no cost to you in addition, beyond the cost of the membership itself, but it does give me a little bit to help support the channel, so I definitely appreciate that. All right, moving on to the next ETF that I plan on buying in Q4 2024 is the IRET, which is the IRET Market Vector Quality REIT Index ETF. With the interest rates being lowered across the board, here in the United States, REITs, or real estate investment trusts, should continue to advance because the lower rates allow them to borrow at lower amounts, and so that's going to help their profitability. As you probably have seen if you're following the REIT sector over the last couple of weeks and months, they have seen a pretty good price appreciation, and I feel like that's going to continue. The estimation is that the Fed is going to lower interest rates at least another % over the next few months. So that's just going to help out real estate investment trusts even more because, again, they borrow money to finance their purchases. And if they have to pay less for that particular interest cost, it's going to be more profitable for them. So looking here at this IREIT, what I love about this one in particular is it has a index approach, but the index is identified by one of the best REIT analysts out there, Brad Thomas from Wide Moat Research. We'll talk a little bit more about that in a second. Looking over the returns, this particular ETF is relatively new. It only started earlier this year, so that's why we only have a partial return. But if you look at it over the time it's been established, it's mostly been going up. So let's look at kind of what it's all about and what they plan on doing. So scrolling down further, so this particular ETF is going to invest solely in real estate investment trusts. It was formed on March 5th, 2024. So as I said, it's only a few months old. So there's a lot, that we still don't know about the total return, what it's going to be in the future, as well as the dividend growth. But it's off to a great start. So let's talk about it a little bit more. So it says the investment seeks to track the performance before fees of the IREIT Market Vector Quality REIT Index. It's a rules-based index, and construction of the index begins with the selection of investments from an initial universe of U.S.-listed equity REITs that comprise the IREIT Equity REIT 100 universe. And so from within that universe, then they pick the actual holdings of the ETF. Again, it was started in March of 2024 and has an expense ratio of 0.60%. Scrolling down, as I said earlier, it's 100% in real estate, and the top 10 holdings as of right now is a who's who of quality REIT companies, including Simon Property Group, Extra Space Storage, Alexandria Real Estate Equities, Camden Property, Rexford Industrial, and so on and so on. So you're going to get the top quality REITs in the space in this particular fund, and they only have 38 holdings, so it's much more selective than some of your other REIT ETFs like USRT or VNQ. Here on Seeking Alpha, the dividend yield is still incorrect because it's a brand new fund. So they're basically calculating it on what the ETF has produced so far, and it's only been about 6 months or 5 months since they started, so they only have a partial year. But as of right now, they're paying around 9 cents per share per month. This is a monthly payer. So if you were to extend that out for the year, we're looking at 9 cents a month times 12 months. If you divide that by the current price, we're going to get about a 4.5% yield. Again, we don't know what the future holds, but if the current dividend continues the way it has over the last couple of months, you should be in that 4 to 5% range going forward. And then we'll see how the dividend increases happen over time. Again, this is a brand new fund. All right, so going out of Seeking Alpha, going to the IRET website. Again, it's the Intelligent REIT ETF designed to provide diversified exposure to common and preferred shares of 40 US listed real estate investment trusts to provide predictable monthly income. Issuance are selected using fundamental research data screened for both quality and value. All right, so looking at the prospectus itself, it's going to take that 100 REITs in the universe, and then it's going to identify the ones that are the highest quality and the best valuation. And it's going to come up with a index of approximately 40 holdings, 40 to 50 holdings that are going to go in this particular ETF. All right, next up, number 3 of the ones I'm going to be buying in Q4 2024 is Alimentation Couche-Tard, better known for here in the United States as the owner of the Circle K gas stations. But they have a lot else to it that we're going to talk about as well. And this one is a wonderful returning company. If you look at the 10-year return, just price appreciation alone is over 240%. So that's an excellent return. It competes with some of the largest tech names when it comes to total return, and you do get a very quality dividend. Who would have thought on a gas station that they could have these types of returns? Let's look a little farther into this company. Trolling down and Seeking Alpha, as we see, it operates and licensed convenience stores in North America, Europe, and Asia. Cigarette products, nicotine, groceries, candies and snacks, gasoline, beer, wine, everything you would expect in a convenience store. They operate under the Circle K, Couche-Tard, Holiday, Ngo, and Mac brands. So if you've ever been driving around in your local town or on your long commute, if you see those particular companies, know that this is Alimentation Couche-Tard. Now, it is a Canadian company, so there are 2 tickers that you can look at. Here in the United States, you have to go with the US version, which is ANCTF. But if you're in Canada, the ticker is ATD.ca. The same company, just one is listed on the Toronto Stock Exchange, the other one is listed here in the United States. Okay, switching over from Seeking Alpha to the company itself, as you see, they operate a bunch of different convenience stores. Probably the primary one that we're aware of here in the United States is Circle K. That's my primary gas station that I go to anytime I need to fill up or go in quick to grab a snack. It's very well known. They're everywhere, and they operate throughout the world, which is very impressive for a company like this. As you see, it has over almost 17,000 stores in 31 countries and has almost 150,000 employees. All right, going back to Seeking Alpha real quick, let's scroll down to some of the details of the company. So as you see, the 3-year revenue CAGR is 13%, so it is a growing company. The profit margins are solid, and we have a very good increase in the dividend. So the current yield is 0.93. So this is going to be for people who don't necessarily need the yield today, but are looking for that long-term growth. And the 5-year dividend CAGR is an astounding 23.55%. So that one is amazing for people who are younger or have a longer time frame, that they're looking for that dividend to grow over time. If it's going to continue at 23.5% compound growth, your dividend is going to double and double and double before you even need the money. It is a quarterly payer, but it has 14 years of growth right now, and I don't see anything that's going to stop them from being able to continue to increase that dividend in the years going forward. Okay, next up of the 5 dividend ETFs and dividend stocks that I plan on buying in Q4 2024 is Clearway Energy, ticker CWEN.A. Now, there's 2 different tickers listed for Clearway Energy. One is just CWEN, and the other one is CWEN.A. I prefer the A because the yield is a little bit higher and you get voting rights. Okay, looking at the 1 year return, this one has been killing it, almost 40% return, not including dividends. And if you look over a longer time frame, you have a 5 year return of 64% and 10-year return is up as well. Unfortunately, Seeking Alpha doesn't have the exact number right now. But what I really like about this company is they're in the renewable energy space. So if you followed any of my videos or follow me on X, you know that I'm a huge renewable energy fan. I do believe that that's the future. So I want to invest my money where the future is. So as you see here on Seeking Alpha, it says they operate the renewable energy business in the United States, operates through conventional and renewable segments, and has about 6,000 net megawatts of installed wind, solar, and energy generation projects. And it was formed in 2012, and it's based in New Jersey. So again, the revenue is going up, the earnings per share is solid, the valuation is reasonable given the type of growth that the company has. And scrolling down to the dividends, this is what really appeals to me a lot right now. And my current timeline for my dividend growth, I want to get some higher yielding. So this one particular currently yields about 5.89%, and the 5 year dividend growth is almost 12%. So that's an amazing combination. They have only grown it for 4 years, so it doesn't quite have the history of some of the other companies right now, but it's in a growing industry. I mean, renewable energies are the future. All the different municipalities and governments around the world are leaning towards renewable energy, as well as the individual companies like Microsoft and companies like that are looking for renewable energy sources to fund their data centers and everything else that they have going on. So there's a lot of future in this particular company in my mind. Okay, scrolling over to their website, as you see, it's Clearway Energy. They have renewable energy throughout the world. So they have 350 current projects, 32 different states, over 11 gigawatts of power. And they have partnerships with a bunch of different communities, and they have over 900 employees. So again, this is the future. They're building the wind, the solar, the energy storage that we're going to need to produce the energy that we need going forward. So again, I really like this company, has a great current dividend, great dividend growth history, as well as good total return. So if you're interested in this type of business, want to maybe get away from the oil or the traditional utilities, this might be a good one to look at. I love it. I'm going to be continuing to add it going forward for the rest of this year and probably for a very long time as well. Okay, last up, and this one's probably going to be more obvious to a lot of people, it's Google, GOOL. Better known as Alphabet. It's the parent company of Google. They also operate a bunch of different companies, which we'll talk about soon. If you're not aware, Google recently started paying a dividend. They just paid out their first dividend just a few days ago. And so while the payout is particularly low right now, I see a lot of future in this company when it comes to the dividend. They are a cash cow. They generate a ton of free cash flow, and they can use that to both grow the business and to pay a continuously increasing dividend going forward. So if you're not aware of who Alphabet is, scroll down through Seeking Alpha, and it says they offer various products and platforms throughout the world. Things like ads, Google Cloud, Gmail, Chrome, Android, YouTube. They kind of do it all, and of course the ubiquitous Google search that everyone uses. So there's a lot of different business lines that they have, as well as the Waymo self-driving cars technology that they're doing. So they have a lot of different business lines that are very profitable, and they will provide income and cash flow for years to come. As you see, revenue is up, earnings are up, everything is looking good. The total growth of the revenue is fantastic, very solid. And what's great about this particular company is the valuation is very reasonable right now. A lot of people think all the Mag 7 tech stocks and whatnot are too overvalued, but Google is one exception. So the PE on a GAAP basis is only 23.5, so that's very reasonable for the type of growth and size and quality of the company you get with Alphabet. So looking down a little bit further about the dividend, so the current yield is only about 0.5% right now. They're paying 0.80 cents per share per year. So that is a very low yield, but what's great about it is their payout ratio, the amount of their earnings they're paying out as dividend, is less than 3%. Typically, you want to see a company paying less than 65%. So as you can tell, the payout ratio is so low that Google has plenty of room in their earnings to be able to grow this dividend over time While they haven't established what their dividend growth rate is going to be, my prediction is probably going to be between 10 and 20% for the next few years, because they do have so much free cash flow and so much earnings, and the payout ratio is so low, they can easily increase it over time. But time will tell, so we will see. So that's one I'm adding to regularly. I love it, especially now that they're paying a dividend. So you get a great combination of the total return that we've seen in this particular company over time. We're looking at the 5 years, we're up over 167%. Plus they're paying a dividend now, which again will only grow in the future, in my opinion. All right, so those are the 5 ETFs and dividend stocks that I plan on purchasing in Q4 2024. To recap, we're talking about REGL, the S&P 400 mid-cap ETF. I'm going to be investing in IRET, which is the REIT ETF. I'm going to be investing in Alimentation Couche-Tard, which is ticker ANCTF for those in the United States, the gas station. Going to be investing in Clearway Energy, CWEN.A, which is a renewable energy company. And lastly, going to be investing in Alphabet/Google, ticker GOOGL. Let me know what you think about these particular investments, and if it's a good time, if you think it's a good time to buy in Q4 2024. And please let me know what you're buying over the next couple of months. Are these on your radar as well, or are you looking at other things? Please let us know. Thank you for joining. If you haven't already, please like and subscribe to the video, share with your friends, and look forward to hearing from you in the comments below. Until next time, keep stockpiling those dividends.